So a lot of people don't really understand what this ownership entails, what it entails to own a share of stock. So for large companies such as like Apple and ExxonMobil, one share is merely a drop in the bucket, right? One share of Amazon stock or Apple stock or Exxon stock is not a lot of ownership in that company. Because, for instance, you look at Apple stock. Apple stock's trading in the mid 100s as far as price per share. Well, how much is Apple worth in market value? Well, over $2 trillion. And so if you own, let's say, $500 worth of Apple, you don't own much of Apple at all, right? You just own a few shares of Apple, but that does not mean that you own any significant proportion. You don't own any significant percentage. So even though you can benefit from the increase in the stock price and any dividends that they may pay to you, you don't own a large amount of their shares. So even if you owned $1 million worth of shares in something like Apple or Exxon, you would still be a small potato. You would still be on the short end of having a lot of equity in order to make changes within the company. So what does this mean? Let's take a look at 3 of the biggest misconceptions that people have about being a shareholder and what it means to be an owner of a company. So misconception number 1 is that in being a shareholder, you are the boss. So first of all, you're better off not thinking that you can bring your share certificates into the corporate headquarters to boss people around and demand a corner office. As the owner of the stock, you've placed your faith in the company's management and how it handles situations. If you're not happy with the management, you can always sell your stock. But if you are happy, you should hold on to the stock and hope for a good return. And furthermore, next time you're pondering whether you are the only person worried about a company's stock price, you should remember that many of the senior company executives probably own as many, if not more, shares than you do. Okay, so you have to keep in mind that you are not the only owner, and you are not the person that is going to come in and just call the shots for a company, especially a large company. So just being a shareholder, yes, you can still have some say, but you do not have say as far as the day-to-day operations of the firm and who works there and who doesn't, and who makes the decisions and who doesn't. Now, this being said, as a common shareholder, you do get voting rights for a company. So you can vote on new directors. You can vote on who does have a say to make changes within a company. You can have say in that way. But you and all the millions of others that own the shares of a company like Apple are going to have to come to some consensus, right? You're going to have to come to some majority rules decision to where you determine who is going to be the leadership of a particular company like Apple. So it isn't a guarantee that a company's stock will do well, but it is a way for companies to give their executives an incentive to maintain or increase the stock's price. Insider ownership is a double-edged sword, though, because executives may get involved in some funny business to artificially increase the stock price and then quickly sell out of their personal holdings for a profit. We have seen this many, many times before, that they do what's called the pump and dump, right? They pump up a stock's price and then dump a bunch of the stock that they own because they can make money in doing so. But there are a lot of regulations around that for executives in publicly traded companies. Even though you can't directly manage the company with your stocks, you can vote for directors who can if your stock has voting rights, which most common stock shares do have voting rights. So these are the people who typically hire upper management, which hires lower management, which hires subordinate employees. Thus, an owner of common stock it does still get a bit of say in controlling the shape and direction of the company, even though this say doesn't mean direct control, and it doesn't mean that you have substantial say. It just means you have some say in what goes on within the company. Now, another misconception when it comes to owning individual shares of stock is that you get some discount on goods or services, right? You think because you are a part owner in the firm, you get some type of discount because you are an owner, right? Being an owner does not translate into discounts. Now, there are definitely some exceptions to this rule. Berkshire Hathaway, so the BRK.A, ticker symbol, for example, has an annual gathering for its shareholders where they can buy goods at a discount from Berkshire Hathaway held companies. So typically, however, the only thing you get with ownership rights of a stock is the ability to participate in the company's profitability. So you get your returns from the company being profitable and growing its free cash flow over time and growing its earnings and growing its revenues. You can participate in that, but you don't get to participate in discounts very often. So why would it hurt for you to get a discount? Well, this answer can get a little complicated, but after some thought, you'd probably not want that discount. As a shareholder, what you want is you want a firm's revenues to be increasing. You want their earnings to be increasing. And if you were to give discounts to the owners, yes, those owners might show up and buy more stuff, but you may also find that it's only the owners coming and buying stuff, and you are losing money based on what you could be making off of the public. Right? So even though an owner of stock may have saved on a purchase of the company's goods, he or she would lose on the investment in the company's stock. Thus, the discount isn't nearly as good as it initially sounds, because those discounts do compound and do have an impact on the firm's bottom line. And so you have to understand that just because you own shares doesn't mean that you, one, can come in and boss anybody around, and it, two, doesn't mean that you can come in and say, hey, I get this at a discount, or I get this for free, or get that for free just because I own shares of the company. That is just not the case. Those are two big misconceptions to owning shares of stock, and that's something that we need to make sure that we understand before we go into owning shares of stock. So you don't have the right to boss people around, and you can't just go in looking for discounts or sales or free stuff. Misconception number 3, though, is that you own the chair, the desk, the pens, the properties, all those types of things. Okay. As an investor in a company, you own a portion of the company, no matter how small that portion is. However, this does not mean that you own the property of the company. So let's go back and think about this for just a minute. Quite often, companies will have loans to pay for property, plant, equipment, inventories, and other things that they need for operations. So let's say that a company received a loan from a local bank under certain conditions whereby the equipment and property are used as collateral. Okay, so for a large company, the loans come in many different forms, such as through a bank, from investors by means of different bond issues. In either case, the owners must pay back the debtors before they get any money back. So for both companies, the debtors, right, have the initial rights of the property, but they typically won't ask for their money back while the companies are profitable and they show the capacity to repay the money. And so as a shareholder, typically you do not own the property, the equipment, the specific means of production that there are, especially in the vast majority of situations where those means of production are purchased via debt, right? Because debt holders have first say. Debt holders have the first rights to anything that the company brings in because they gave you money and they expect to be repaid, right? As a shareholder, you only get what are called residual rights. You get rights to the residual income of the company, right? But the income that is residual, meaning left over, that only comes after you pay the creditors, right? And in most cases, companies are financing property. They are financing large pieces of equipment via debt. And so they are going to have to pay those creditors back in the first place, okay? So the bottom line with these 3 big misconceptions are that no, you are not the boss just because you own shares of a company. No, you do not get discounts on goods and services, and you don't get free stuff just because you own shares in a company. And you're not necessarily the owner of every chair, every office, every desk, every building, every piece of equipment. You just aren't as a common shareholder. As a common shareholder, you do have rights. And your rights are really relegated to voting, and they really are relegated to the residual profits of the firm. But you do not get a say in absolutely everything just because you are an owner of a firm, just because you own some of the firm's shares.